For Chapter 5 so far, we've looked at a direct financing and a sales type lease. Now we're going to look at a bond example. When one of the parties has bonds outstanding, often it's the sub, we want to repurchase those bonds or redeem the bonds if the interest rate has gone down, and therefore sometimes we have one of the other parties redeeming the bonds. That's the example here in problem 1. When that happens, one party has an investment in the bonds and one party has the payable, all intermediate 2 material if you recall, and we have to eliminate those two pieces. So it's similar to the leases in that we're eliminating a payable and a receivable that offset each other, and we're eliminating the corresponding interest, but we may also have a difference between that payable and receivable because the bonds were repurchased at a price different than what they were issued. And that's what we're going to look at here. So if you look at problem 1, you can read the text material there describing what happened, but you can also look directly at the trial balance of the two parties, the parent and the sub. And the bulk of our entry comes right from those trial balances. And that's key when you're doing bond activity. So if we look at the bonds payable itself is on the subsidiary's book, which is often the case, at $50,000. Well, it told us in the text that those were fully redeemed or purchased back, so they're not outstanding with an outside party, so we're going to eliminate those. The investment that the parent made to redeem them is shown under their trial balance at $46,500. That's what they paid, the $46,000 that was given, plus the amortization that's occurred to date on the difference in what they paid. So that's eliminating the payable and the receivable, or the investment in this case is the equivalent of our receivable. Then we also have to take care of the interest. So if we look down again on the parent, we see the parent had income of $4,000 while the payable itself was $3,500, because again that amortization of the difference, that's where that $500 change in the investment came. And the entry doesn't balance because this is the year that the bonds were repurchased. And from the text material you see that 50,000 of bonds were redeemed for 46. So we actually had a gain on the redemption of those bonds. Now this gain doesn't exist on either party's books yet. We're going to make that gain as part of the worksheet, and it actually becomes part of the consolidated income statement then. So that's your basic entry here for B1, and that's the concepts that happen in B1. Then to finish off the problem, we're simply going to do an abbreviated income statement here by taking the parent's sales and the sub-sales that are given in the book, and cost of goods sold that is given for both parties, and the other expenses, and then we're going to add in the gain. And therefore we get to consolidated net income of $813. So that should help you with your homework.